The dysfunction surrounding the election of a House Speaker isn't letting up anytime soon. And now with lawmakers back in Washington, the pressure is mounting for GOP members. Now, conservative Jim Jordan is pursuing his quest this week with the House expected to vote tomorrow. If Jordan is elected, what will that mean for investors, for the broader market? Here with us now, I want to bring in Ben Emons, a senior portfolio manager and head of fixed income and macro at NewEdge Wealth. Ben, it's great to have you here on set. Lots to get into with you here today, but let's first start with the House Speaker race, exactly what this could mean for investors. If Jim Jordan has an uphill battle here, if he is elected House Speaker, how should we expect the markets to respond?
So I have a take on this, actually. Obviously he's somewhat controversial and he has a lot of really, I'd say, stark opinions. But one thing that he is really in favor of is to cut fiscal spending very dramatically. Now, one of the things that's been happening over the last, say, 3 months, Treasury yields continue to rise because we are issuing a lot more bonds because obviously we're spending a lot of money. Now, it's not so simple to change fiscal spending, but he's one of that is probably going to be, in the House, a really strong voice and try to drive the spending to a lower level. And there's more people on board with that view. So I think if he does become Speaker, ironically, the bond market would potentially embrace that as a positive because, it means in the future less supply. And that, I think, is meaningful for markets given what we've been through over the last few months.
I mean, it still sounds like, so for the party, even if they were to come together around Jordan, then they would still have to figure out, okay, what is our strategy and policy going forward even further from here? What do you need to see from the party's policy to emerge around some economic kind of stability to prevail once we get into 2024 and even beyond then?
Yeah, and that is an open question, Brett, because, on the one hand, you can say, let's cut spending down to the bone, but that's not that simple because it affects the economy really immediately almost, and it's an election year, so it's not that straightforward. On the other hand, it's about, what is the right level of fiscal spending and balanced budget, and there's just not good ideas about it, both Democratic and GOP. So I think this is going to be an uncertain situation. So as much as it may be he could be embraced as positive, as in markets try to discount something from it, I think it's the uncertainty about what's going to happen to fiscal spending in next year and how it's going to change that could lead to more volatility in interest rates. And that's what we're seeing playing out as we speak.
Ben, what's your assessment just of the bond market right now, more specifically what we're seeing in treasuries? Because we have also renewed risk going off the growing escalation of the Middle East conflict, what the potential ripple effects of that is going to be. When you take a look at where yields are now, those levels, how much higher do you see them potentially trending?
So it's amazing that normally in a flight to safety environment, which we're sort of in currently, and the news today is that they're ready to invade Gaza at some point, right? If these refugees comes out and humanitarian aid is given, you probably can expect to be ground assault. And Swiss franc, gold, and those type of safe havens are up, but treasuries are not. And I think there's two things going on. One, it is this supply, this fiscal picture that's continuing to pressure yields. But on the other hand, it's that we don't really know how Iran is going to be involved one way or the other. And that's where the oil markets are focused on. Lots of views that the oil could go to $100 or even $150 a barrel in the event that there will be some sort of a involvement of Iran and tension, and that the supply from Iran, oil production will be cut down significantly. Yeah, and that drives up treasury yields because amazingly, as much as we went up in yields over the last, say, 3 months, there's been very little inflation risk priced into treasury yields. The inflation break even, as we say, between real yields and nominal yields has been very flat, very stable. Mm-hmm. And that has to do with, I think, that people expect the Fed to raise rates enough that inflation will stay contained. So as it is underpriced, inflation risk, and this risk of a oil spike may happen, then treasury yields could fluctuate a lot and not be the safe haven, even if you have a flight to safety environment.
How does that conflict, though, also impact some of the monetary policy or even fiscal policy around the world? Other markets that have either tried to get inflation under control in their own measures or just tried, in China's case, to stimulate the economy?
Yeah, so if you take a step back and what happened with Ukraine last year, went into that situation, and we didn't have a good sense of what it actually meant. There was some complacent views even about, this one maybe just locally there. And it turned out to be that it was a major oil food shock, so to speak, meaning food was really becoming elevated part of inflation. With Israel, it's about chips. It plays a really important a key player in the chip supply chain. So you get this disruption there that's going to affect that supply chain. We know what that could do. Right? It could impact auto production. It could impact different areas. So there's this other inflationary impact there that we don't really know how that's going to play out. So to monetary policy and fiscal policy globally, you would once again see monetary policy at some point react and say this higher for longer is even higher and then longer, right? Whereas in the case of fiscal policy would be that ongoing, challenge about rounding, basically surrounding Israel and saying, I will give you all the support. But as we know in the home base here, there's a lot of challenge with that, right? So I think it's just a lot of uncertainty, right, that we're looking at.
And has this at all changed your base case in terms of whether or not we're going to see a recession? When we talk about a potential here for a pullback, how big of a pullback should investors be bracing for?
I think under the scenario of this $100 to $150 a barrel for oil, that would be really an effect on the economy here. We would get way too high gas prices again, against already a slowing economy. That would bring the recession again forward. Now, Wall Street Journal had a nice article this weekend that the probability of recession has really fallen a lot because, we're spending a lot of fiscal money and that's affecting the economy positively. So that would be the other scenario. If we're getting political tension around fiscal spending, the combination of high oil prices and that could slow the economy more down. I'm of the view still, though, that the economy is still not really close to any kind of recession, really because we have robust spending and consumer confidence being more affected by inflation overall, the political environment, than actually the economy. Plus, we have investment in the economy. Otherwise, treasury yields would be starting declining quite significantly. So, but that these risks are there are clear. High oil prices and change of fiscal policy, that's something I think we have to start counting, factoring in our investment policy and investment strategy next year.
Ben Emons, great to have you here in studio with us. NewEdge Wealth Insider Wealth Senior Portfolio Manager and Head of Fixed Income. Thanks so much.
Thank you. Thanks for having me.